The first quarter of 2020 took the entire world by surprise after the fallout from COVID-19 and oil price crash led global GDP to its first contraction since 2008. Markets were battered hard in March for risk assets, and central banks around the globe, including Malaysia, reacted with lightning speed by cutting interest rates and reserve ratios back to global financial crisis levels. Notwithstanding to monetary action, governments around the world also announced massive stimulus plans aimed at cushioning the lost income by the unemployed, as well as an effort to maintain economic activity pre- and post-COVID-19's unprecedented lockdown. In the fixed income universe, the sell-off started after US dollar-denominated bonds faced a liquidity crunch, which resulted in a run for cash. The US Fed immediately introduced a slew of quantitative easing facilities to alleviate that liquidity crunch. The bond markets here in ASEAN was not spared, as the risk-off sentiment sent yields backing up from their all-time lows. On the positive side, new COVID-19 cases appeared to have peaked in key European countries such as Italy, Spain, Germany, and France. In our view, the unprecedented lockdown in many countries is likely to be a 1 to 3 month issue instead of a 9-month issue. The recently announced monetary and fiscal policy easing across the globe is massively stimulating and should cushion the slowdown somewhat. The risk to our view is a resurgence of new cases, which may delay the recovery of economic activity for the rest of 2020. GDP forecasts across the world continues to tumble as social lockdowns become more widespread and the impact it has on economic activity. Government intervention in developed and emerging economies have been decisive, given the economic packages that were announced in the month of February and March are well above GFC standards. In light of these challenges, we think that central banks in ASEAN would keep their interest rate policies accommodative and noting that fiscal policy will carry the brunt of stimulating economic activity moving forward. Economic conditions is set to improve when governments around the globe start to relax social lockdown requirements as the COVID-19 risk starts to recede. The US Fed continues to expand the reach of its quantitative easing policy designed to combat the COVID-19 recession and has given itself the ability to even buy BB high-yield bonds within its corporate bond buying program. The increase in government spending for 2020 will also mark a jump in bond issuances, which should be absorbed by the liquidity supplied by central banks around the world. In the absence of credit downgrade, this should help keep credit spreads in check for high-grade USD-denominated bonds with some probability of a bias towards tightening. Valuations are cheap, but fundamentals need to improve. We cannot ignore credit defaults in this environment, can we? While valuations for corporate bonds is starting to look attractive, we think that it is mostly due to rising credit and liquidity risk premia. With no clear visibility on how soon the COVID-19 will come to an end and at what cost, we are in no rush to bottom pick on the credit market. With the expectation of easier monetary policy, we may still tactically position into short and medium government bonds. Within fixed income, central banks in Indonesia, Malaysia, and Thailand can cut policy rates further, but Thailand is closest to the zero bound. Further rate cuts may not lead to sustainable rallies given that economic stress that might lead to issuers' credit profile weaker. We expect lower credit quality bonds to face headwinds, and it would be crucial for these groups of issuers to shore up financial buffers to weather the uncertainties around the COVID-19 lockdown. In this instance, we prefer corporate names with relatively strong credit ratings, which inherently displays a solid balance sheet along with stable cash flows. We continue to hold our neutral duration strategy for the bond markets in Malaysia, Thailand, and Indonesia. Thank you very much for your time.